Okay, so today we're going to jump into what are some reasons you would get a reverse mortgage, right? So a reverse loan it has a lot of negative stigmas out there. Some of them are correct, some of them are right in the sense that there was a period of time that reverse mortgages probably wasn't the greatest product to get if you were anyone owning a home, right? That has changed dramatically. So I'm going to talk on a couple of the myths and then I'll jump into some of the whys as why you would get it. So a few of the myths are that you don't own your home, right? You do own your home. It's a mortgage. It is debt just like any other debt. The big difference between a reverse loan and a regular forward mortgage, which is what a 30-year fix is called, is a forward mortgage, which means that you have a loan that you pay monthly installments on and you pay it down over a period of time. Reverse mortgage is you still have a loan, you just don't owe any payments, and the interest negative amortizes, which means that the balance grows based on every month you don't make a payment, that interest compounds and you owe more. So it's still just debt. At the end of the day, it is not the bank taking your house from the jump. The only way they can take your house is if you go against the promissory note and don't pay taxes, don't pay insurance, commit fraud, and don't actually live in the house for 6 months a year, right? You got to break your promissory note, break your promise to be at risk of foreclosure, just like you do with a regular loan, right? So a regular forward mortgage, you've got to not make the principal and interest payment, not keep taxes up to date, not keep insurance, break your promissory note for the bank to take action, right? So it's not a end all be all of the bank saying like, hey, we own your house, right? Um, it's just a different way of how the payment flows in the fact that you don't owe principal and interest every single month. So the fact that you don't owe principal and interest every single month in terms of an actual payment made, it just means that your principal stays where it's at and your interest accumulates, which just means you owe more as you own the home. So it's just a different way of approaching debt, right? So that's the big one. The second one is that it will put your heirs or whoever is inheriting your home in a bad position taking over the house, right? I think that's the one that gets over stigmatized to a degree or another. Maybe the bank trying to steal your house does a little bit, but really the problem is that sometimes the negative occurrences that have happened with reverse loans, you've got to think of the situations that have occurred with a reverse mortgage in the time that that's happened is a emotional time. It's usually in the scenario that, hey, mom just passed away, she left us her house, and dealing with the bank has been a nightmare. There's a little bit of an emotional amplification there happening. Mom just died, right? So, like, yeah, of course, dealing with any of her stuff is going to be tough, right? Cleaning out the house in general, doing anything, relative to that. If you loved your mom and had a good relationship with her, mom and dad, whatever it is, it's going to create some extra stress in the situation. And if it isn't a perfect outcome afterwards, and maybe you disagree with, oh, I can't believe mom got a reverse loan and she only owed 200 grand 5 years ago and now she owes 300. The bank is stealing her money and like it's just going to amplify that situation for the fact that you're going through an emotional time. And that's the stories that exist out there in the market for reverse loans is it's the people telling the story after the person's used the reverse loan and they're telling it from the timestamp of when the negative thing happened to that period of time, right? Mom passed away, the bank sucks to work with, reverse loans are horrible. They're not really talking about the time frame beforehand where now mom was able to go with the family to Disney World in the previous years because she got some financial freedom because she had the reverse loan and didn't have a mortgage payment to make, right? Those are the positives. The negatives get amplified way more than the positives do from that standpoint. And the stigma there is if you take over a reverse mortgage from a family member or whoever you're inheriting the house from and it has a reverse loan on it, if it's an FHA loan, which a lot of the reverse mortgages are, you actually have a whole year to sort out the situation and not owe a payment. You can buy the house, you can refinance it, you can sell it, you can short sell it if they're underwater and you're not dealing with that negative there. If you take over your parents' house and they have a regular loan, you got to make payments right away, right? Like that's instant. The moment you take over, the bank's like, hey, there's a payment due next month. Who's paying it, right? So you actually get a little bit of a benefit if mom and dad or whoever had the reverse mortgage you get some flexibility, right? You get a little leeway to, kind of go through all the personal situation. Okay, what are we doing with grandma? Does anyone want to buy it in the family? Does anyone want to keep it, take over the loan and refinance it or sell it? Or what are we going to? You have some wiggle room. There's not a pressure of a mortgage payment due next month, right? That's worse in my book. So those are the two big stigmas that get popped up, right? Is the bank's going to steal my house, and the bank screwed over grandma all those years because now we're dealing with it because grandma's no longer here, and now we're dealing with the reverse loan, right? Over amplified in the market space isn't the actual case. Okay. So now, from that standpoint, who is a good candidate for a reverse loan, right? I think a lot of times people think about someone who's at the end of their financial wits and their only option is to use their equity to either survive or refinance their current loan to a reverse loan so they don't have a payment to survive, which 100% it is a good product for both of those people, right? So if you have someone who's in a bad position that wants to stay in their home, they don't want to move, they don't want to have to sell just to survive and go live somewhere they don't want to live. They want to live in their family house, they raise their family in whatever, right? In that situation, yes, it is definitely a tool that can be used, right? The scenario of, the elderly couple, they want to stay in their house, they're on fixed income, they own their house outright. Maybe that's a majority of their savings and their wealth is in their home. They have a little bit of savings, but they're dwindling and running out on it. A lot of those people start talking to banks about home equity lines of credit. Home equity lines of credit are a cascade of debt that could make their life even worse, and then you get worried about outliving the draw period of your home equity line of credit, right? Like if you're 80 years old, you sit down with the banker and go, hey, we're going to pull a line of credit to live off of. That line of credit's only good for 10 years, and you got to make a payment on it every single month. So if you're living off your line of credit and you're also paying on your line of credit, you're probably increasing your line of credit to live off your line of credit as well as pay for the line of credit. And eventually that line of credit is going to have a expiration date on the draw period. Is usually 10 years. If you live past that 10 years, you got payments. Now you're in a bad spot and not good. You would have been better off getting the reverse loan, pulling out some equity that way. You can make payments to a reverse loan if you want to. If you don't want the debt to grow too much, now we get some money, let's throw some money against it. But there's no term on a reverse loan. So if you pull out that equity to survive and you're using it strategically, you don't have to worry about like, do I outlive the term here? Because if you're 70 and you pull a line of credit and you live to 90, which God bless, hopefully you do, that line of credit might have not actually served you well because 10 years you used all of it. Now you just have interest payments and now it's a suck on your financial life and not a benefit, right? Whereas the reverse loan, pull that line of credit, you can use it like a line of credit, use it, pay it down, use it, pay it down. The equity is going to grow, so your line of credit is going to grow with your equity. That's kind of a weird way of how the line of credits work from the standpoint of a reverse loan if you get the right structure. And then there's no term. So you just have that loan until an event occurs. The event is you pass away or you move out of the house and sell it. So you just have that loan. There's no 30 years, 20 years, whatever. It's just here's your loan, here's your effective rate table, and here's how much your interest you're going to pay if you don't do anything. Here's how much your interest is going to grow. It's actually more straightforward than the home equity line of credit as long as you get past the stigma, right? So that's one way. Someone who is in a destitute position, they want to refinance a current mortgage to get to a position where now they don't have a payment. Definitely, hey, I owe 300 grand. Our mortgage payments is 1,500 bucks a month. The 1,500 bucks a month is a big difference for us. Refinance that 300 grand to a reverse loan. Don't do anything else with it, and then no payment, right? And just now you owe more, and you're going to owe more yearly, but you're cool trading owing more later because it's unfortunately not going to be your problem. Owing more later to live better now. It's a financial tool. It's not a good wealth creator, if that makes sense. Whereas a 30-year fixed buying a home, all those years prior, it was a wealth creator. A reverse mortgage in that sense, not necessarily as a wealth creator, it is a lifestyle improvement. Whereas like now I have an extra 1,500 bucks a month. to kind of let the pressure out of my life because maybe I'm only living off of our pension, social security, and a little draw from a retirement plan. And the $1,500 becomes crucially important, right? And then the people that own their house outright need to use some of their equity for the same reason. You could pull a variable line of credit with the HELOC, with the home equity reverse mortgage, a heck home equity conversion loan, and treat it like a line of credit, money in, money out, and strategically use it there, even if you are in that position where, like, hey, we need 200 grand to live off of for the next 5 years, 10 years, 20 years, whatever it is. A lot better than the line of credit, right? So that's one person, the person that's in a bad pinch, and the only thing they really have is a house. And that's probably the most commonly known aspect of a reverse loan is that saving grace portion of it. But there's other parts of it that I think are incredibly underutilized from a strategic standpoint, right? One, you can use it if you don't need your equity. Let's say you're someone who did really good in life, you got a good pension, you got a ton of equity in your house, you're doing great, you're really not in a bad financial position. So you're thinking like reverse loan, that doesn't make any sense. We're fine, right? We own our house outright. We have a couple million in a 401k. I got 5 grand a month coming in a pension. We live well below our means. We're in a good spot. There's a second strategy that can be utilized with the reverse loan. And it has more to do with having a conversation with your financial planner where you pull a reverse loan but don't actually take the balance out, or you pay the balance down. You're like, hey, give me 250 grand, you take the 250 grand, but then you pay the 250 grand off, like a line of credit or a credit card. So then you don't owe anything technically. So you don't have interest accumulating against you, but you have an open reverse loan, right? And you could do that. You could do an adjustable rate FHA open reverse loan. You got to take a small amount up front to begin with, but you can pay it down to zero. And then essentially you just have a line of credit that you could treat like a line of credit, that the line of credit is actually going to grow based on the interest rate because your interest rate is this weird effective rate at a scale. So you're going to start at 250, and then year two, you might have a available line of credit at 257, and then 264, and then so on and so forth. So your available line of credit is actually going to grow in the same math that it would if you owed 250 and then you owed interest. So your available line of credit will grow, and that's how the interest kind of moves. Without getting too technical, back to the strategy piece of it. For that person that's drawing from a 401k, they're no longer earning and putting into the 401k. So now that 401k is moving based on the market, right? Or IRA, whatever portfolio of money you got going on, that's moving with the market. And now you're having conversations with your financial planner on strategically withdrawing and selling assets at the right time. And if the market's not good, it could be a really bad negative compounding effect, right? Like if you have a portfolio that's worth $2 million, but the market goes through a little bit of a bear market, and now it's only worth 1.2, and you're looking at that as like, this is my nest egg to survive off of. And we need 60 grand to live off of this year based on how we've planned our retirement and the trips we're doing and, all of our expenses, like our pension gets the job done to a degree or another. But, we kind of planned on drawing 50 to 60 grand a year based on how well our portfolio is going, but the market's not performing the way we want it to. And you're sitting there across from your financial advisor saying like, hey, if you pull 60 grand this year, because it was at 2 million last year and now it's at 1.2, you lost a crap ton of value in your portfolio. You need to sell in excess the same amount of quantity of your portfolio to generate the same outcome in the cash value, which means that you don't get the rubber band rebound effect if the market does rebound and inflates back up to 2 million, which happens a lot in the market. The market contracts and goes up, right? Like it happens frequently. If you sell when it contracts to create the same cash outcome, you might be selling a big chunk of your portfolio and you lose that ability for it to really grow back to the number that you need for that draw position, right? So that could be a really big negative compound. In that scenario, a reverse loan can be a really good strategic play. So you're like sitting there with your financial advisor saying, hey, it's our yearly review. We're gonna grab our 60 grand. We're gonna sell this, sell that. Financial advisor's like, is there a way you can maybe do it? If you have the reverse loan already open, you just pull 60 grand from your equity. You don't owe any payment on it. You leave your portfolio alone and don't pull anything from it. You let it rebound. You still get the money you need to survive that year. Yeah, you went into debt to do it, but the debt you don't have to make a payment on. So it's just you still paying your taxes and your insurance. Yes, it's going to grow in balance. So you take your 60 grand and now interest will accumulate on that. But probably a better play than liquidating your portfolio in a down market, right? There's a table that I had it for different presentations. I don't have it right now, but it showed someone who drew their portfolio and ran out of money by the time they were 80, which is terrifying, right? Like that's again, like, do you want to outlive your money? I've had family members in that, but it's not fun, right? I think anyone watching this video probably knows someone that's been in that position in their life, and it's never a good position, right? To be, hey, I'm outliving my money and I have to now work well beyond my working years to survive. No good. So in that scenario, and you did everything right. You have a house, and now you're talking about, oh, grandma needs to sell her house just to live. She's got to pull a line of credit just to live because she ran out of the portfolio. Because God forbid, your timing is that, you're retired in '08, right? And the market's like, hey, too bad. Here's a big fat goose egg that, I'm spitting out on you. Not your fault. You did everything right leading into your 80s. And now you're like, well, my retirement just went from, I had $1 million that was pretty much me going to survive and live a good life until I die. And now I only have 250 grand. That's, now I have to live a really constricted life and then die. Like, that's just no fun. No one wants to do that, right? That's why we have Social Security. It's why we have these things. But either way, the table showed people that then use the strategy of drawing against your reverse loan during down times in the market and picking and playing it out. And it made their portfolio last substantially longer. Yes, they grew debt in a different class. You put them next to each other and said, hey, here's all of your financial assets and here's your debt. Yes, I'm going to grow your debt, but I'm not changing your budget monthly because you don't have a mortgage payment again, because reverse loan, there's no payment. And these are your money. This is your assets to draw against. Now we can draw against these strategically and then draw against the debt strategically so that you have a better outcome of life. Again, back to that topic of the reverse loan is not a wealth creator in the sense of gaining equity, because you're going to lose equity when you use it. It is a life balance improvement at that stage of life, right? That's the best thing. And the other pieces are, most people don't know that you can actually buy a home with a reverse loan. So it's great for right sizers, right? So if you got clients that are sitting in their colonial and they're like, hey, we love this house. We don't actually want to retire here forever. The kids are all out. We're 65 years old, 70 years old. We're still kind of working. We're not really reverse loan. What do you mean reverse loan? I'm not retired. I'm not in a bad financial position, right? But maybe a lot of their money is tied up in the house, or maybe they don't want to go through the process of selling and buying simultaneously, and they don't really qualify for the next house while maintaining the current house. So it's just a little logjam, but they have a down payment for the next house, but the debt to income doesn't quite make sense or whatever. You can go buy the next house with the reverse loan, make a down payment, and then from there, sell the current house, pay that off, pay off the reverse loan, and still have the same outcome of having a cash offer, right? From the standpoint of a consumer budget. Or it creates the strategy of, again, hey, we bought the right size condo. We just sold our colonial. We're sitting down next to our financial advisor. We didn't know capital gains because we lived in our colonial long enough that, we made a lot of money, a lot of it free and clear, and we didn't really have to pay taxes. What makes more sense? Should we pay off the reverse loan, or should we put our money to work in the market, right? Like, it can create a lot of different strategic financial outcomes that people aren't even having conversations about because of the first two things I talked about at the beginning of this video, the stigmas that stop people from even having the strategic conversation about rolling in a reverse loan to help financially, right? Because they think of it as this thief in the night that's going to steal your house and steal your equity. Your equity is definitely going to go away, but does it create a better positive outcome, right? Like if what's the best outcome of what you're trying to do as a consumer at that stage of life? You're trying to keep your fixed financial costs low because you have a fixed income. Your earning years are done, right? A lot of people. So you're trying to keep your fixed monthly expenses down. It doesn't matter as much in terms of what you have for equity, right? Equity is a young person's game that you're starting to get as you're developing your wealth and getting to that position. Equity is crucially important to start doing that and investing correctly and all of that. But the tides kind of flip a little bit when you get to that next stage of life, right? And as long as you can get past the first few stigmas, you can really have good strategic conversations about reverse loans and the benefits and all that fun stuff, right? So that's really the main two things that I like to go over with reverse loans is strategically they're a lot more in depth than most people give them granted for. And you could do a lot of fun things with them, right? You only have to stay in the house for 6 months. So one other piece of it too is let's say you have the colonial up here in New England. Let's say you're the couple that's like, hey, we've always wanted to do the snowbird thing and buy like a little place down in Florida, a little place in North Carolina, but we don't want to have another mortgage. If we spend our cash, then we don't have our cash anymore to live off of. So that's not a good strategic investment either. What you can do is you could say, hey, we own our colonial up here free and clear, right? And we like the fact that we only pay taxes, insurance, and maintenance, and that fits our budget. But we could afford taxes, insurance, and maintenance on a condo in Florida too. We've done the math, and we'd love to be able to do that, right? The back and forth. That's part of like the lifestyle that we want to have. But financially, it's not perfectly there. You could pull a reverse loan on your primary home up here in New England that you plan on living in for 6 months a year, and you plan on living in Florida for 6 months. All you have to do to meet the criteria of it being your primary home for a reverse loan. Pull 500 grand from that house. That's maybe being a little crazy. Pull 350, 400 grand, go buy the condo down in Florida or a single family, whatever, cash. You've done the math. I'm like, okay, we can afford the HOA, the payment, everything's good. Yep, we're going to buy it. Now we have the two houses, and you still get the same outcome monthly budget wise. Yes, you went into more debt, but you still don't have a principal and interest mortgage payment up north. You own a house cash down in Florida that you paid 400 grand for, right? You have maintenance, you have the expenses of owning a home. That doesn't make any of that go away. But you now own a property in Florida cash. You own a property in New England with a loan on it that's going to grow in value if you don't make any payments. It's going to grow in interest. And there's no rules. You can rent out that other place in Florida throughout the year, right? So if you're not there, rent it out, right? So like there's a lot of fun strategies that people aren't even having conversations about with reverse loans because they're too nervous, the stigma's too high. But that's the most fun one where it's like, because that's what you want to do at that stage of life, right? Like you've already lived logically and pragmatically. You want to have some fun. Like that's what I remember joking with my grandparents. Like sell everything and go buy a Corvette and enjoy your life. You've already done all the work, right? Like this is the cherry on top of your life. I hope you're enjoying retirement when you get there and you're not miserable with a financial burden. Like I don't think anyone wants their family to be in that spot, right? Like so we hope that our grandparents and parents are enjoying that stage of life, right? And if the reverse loan can help facilitate the enjoyment in that stage of life, that should be the majority of the conversation you're having is not to underscore the fact that there is financial risk with a reverse loan in sense of what it does actually do. You really need to understand that. Like it's not just free money. You got to grasp the reality of what it is. And I think that just means working with a mortgage professional who's honest, transparent, and truthful. And then from there, does it make a better life for you? Those are probably the two actual tests you should look at. What are the real risks? What am I really signing up for? You're signing up for debt, same way you're signing up for any mortgage. And I'm signing up for a better lifestyle. And if you're okay with the real risks and it creates a better lifestyle, it is 100% a piece of your financial conversation you should be having. If you're planning your retirement, already in your retirement, or you know someone in that stage that is facing some of these issues, saying like, hey, how's grandma going to make it? Grandma and grandpa keep talking about wanting to have a place in Florida, but they just can't pull the trigger financially. and they have a house that's worth 1.2 million. They've owned it since 1960, and that's where all of their money is. And they joke about like, well, if we just sold this house, we can move to Florida, but then we're not near the family anymore, right? Like the reverse loan, buy the second house in Florida, be a snowbird in the winter, go back and forth and create a similar budget outcome, right? Obviously, there's variables. Now own two houses. That's something you got to account for. So, like, it's not free money, but it's definitely a loan program that is incredibly underutilized, under talked about, because it has a little bit of a negative stigma associated to it. And again, I know there's probably some truth behind that. Just like an adjustable rate mortgage has some stigma left over from the 07, 08 market. And there's some truth behind that. It's a riskier loan than a 30-year fixed. So you need to know you're working with a loan officer that tells you the truth and says, hey, this is an adjustable rate mortgage. I don't know what rates you're going to do in 5 years when your rates could adjust. It could go to 10% in 7 years. It could go to 11% in 7 years, right? You need to just know what you're signing up for and work with someone who's willing to put the time, effort in to give you the information needed to help you make an informed and educated decision as to whether or not this product program structure is the right outcome for your goals and your life financially and what you're trying to do with enjoying your life, right? So that's my spiel on the reverse loan. I hope this was some good information. It's some good conversations you can have if you're a realtor out there in the market and you're trying to kick the bee's nest to get some business. The fact that you can buy a house with a reverse loan is very under talked about. That might be a great way to kind of break into all those colonials that, the boomer generation right now is just not selling, they're sitting on. They might not know that they could do something along those lines, right? They might not know, hey, we got a little bit of a down payment. Let's go buy the Florida house now with the reverse loan, move there so we don't have a mortgage payment. Then we'll sell the house up here. Because a lot of people right now aren't selling just because the inconvenience of selling and buying simultaneously, right? So this is a way you can speak to the market's problems and say, hey, if you're in this class of people, I might have a solution for you. I might be able to help you buy the next house before selling the current house and create the same budget outcome of selling the house now and buying the next house cash, which is you don't have a mortgage payment on either house. You have debt, but you don't have a mortgage payment on either house, right? And it might bridge you, probably better than a bridge loan, might bridge you to the next house, sell your current house, take that liquidity, make a good financial decision with a financial planner. Hopefully someone in retirement has a financial planner, particularly if you're ever coming into 500 grand or more in your pocket. Sit down with a financial analysis or advisor. Should I pay off my reverse loan or should I park it in the market, right? Should I put it in bonds? Should I put it in a money market that gets me 3.5%, right? What should I do? Because what I like to view equity as is equity is useless until you do something with it. Liquidity is powerful. So it's really beneficial to have those conversations with people that are in that log jam of like, we want to do something, but it's more convenient and easy to stay where we are. If you can help with the convenience and ease of moving, the reverse loan might do that for some people, not everyone, but it's worth it to know that you have that in your quiver of arrows as you're prospecting in the market, looking for really what we should be looking for in the market is solving problems, right? So you're trying to solve the problem of a seller, right? Why isn't someone selling right now that they want to sell? There's some problem there that we need to help solve in the market as professionals, right? So the reverse mortgage might help some of those. So reach out if you have any questions. More than happy to dive in with you one-on-one. I hope this was relevant, and I'll see you guys in 2 weeks. I'm in Florida next week.